So how does this dividend-paying whole life insurance create that volatility buffer for us?
This is something that Dave and I do in our own lives, right? We invest money, but then we also have our liquid capital that we keep safe. So what you can do in a down market to address that sequence of returns risk, which matters when you start taking money from this money that you've accumulated over your lifetime of working, is, hey, oh gosh, the market tanked. I don't want to take from these investments, right? I want to wait until these investments rebound, right? So those shares are more valuable. So what I can do is I can go to my boring, guaranteed, participating whole life insurance contract, and I can take a policy loan to bridge the gap until that market recovers, which could be 6 months, could be 18 months, who knows? Could be 3 years. But if you've capitalized properly, you're going to have a ton of death benefit for your family, and you're going to have plenty of cash to weather the storm.
And you can access all of that cash tax-free. So you could actually take out less than what you've taken out of your 401k because none of that's going to be taxable to you.
No, that's a great point, Dave.
Yeah. So,
and it's not a withdrawal. So this is an advantage, not a disadvantage of dividend-paying whole life. And this strategy is that you can put the money back. If you take a policy loan, you'll have an opportunity to replenish that loan so that you can use that money again for the next time the market tanks.
Yep. And in the meantime, while you're taking it out and you're using it to fund your lifestyle, it's still growing and compounding inside that policy as if you never took it out. So you get the uninterrupted compound growth, access to that tax-free capital anytime you need it. Now let's talk about more of the banking side of this and why you and I promote this so much and use it in our own lives with all the dozens of policies that we have between the two of us is the access to capital piece. So when you get to retirement, once you've had these policies for a number of years, call it even as short as 5 years. So if you're 60 years old, you say, I'm going to fly to 65, it's not too late for something like this. You've still got 5 years to build this thing up to the point that when you retire, every dollar you're paying in premium is creating more than $1 in cash value that year in most cases. So you're getting a positive return. It's almost like a money multiplier. Now, if you start this in your 30s or your 40s, it's going to be multiples. You put $1 in retirement, you get $3, $4, $5, $6, $7, $8, $9, $10 out, depending on how long you've had this and how it's designed. So it's a money multiplier in retirement. You get access to all that extra cash, again, tax-free.
No, it's absolutely. So obviously the longer you're in this, the better, but it's just a great place to store cash, right? To just put money. Right. And I'm not talking about money you're going to pay your grocery bill with, right? It's money that you're planning on using for something. It's your emergency fund, it's your opportunity fund, maybe it's your boat fund, it's your classic car fund, whatever, it's your kids' college fund times 3 or times 4. It's all of that. All of those are available premium dollars that you should be capitalizing somewhere under your control. And if you do that properly, all of those dollars are now yours forever so that you can do what Dave just outlined, right? I can weather the storm, and I have this tax-free bucket that I can access for the rest of my life.
Yep. Well said.